Welcome to my class on Forex trading. Now today we're going to be discussing the introduction and basics. Okay. Before you can jump in full, hog wild, wherever you're going to invest money, you have to know and understand the basis of everything. Not the basis of how to make a trade. We're not even ready for that. You need to understand what Forex trading is, what it's all about, and the terms that are important, the concepts that are important, because if you jump in the other way, you're going to lose your investment and go away, and it's only going to be your fault. I mean, just like a baby, you need to learn to take baby steps before you can walk, before you can run. Okay, forming sentences. Remember when we were in school, we learned words. Then we learned how to put those words in little sentences. Then we learned how to make sentences that made sense. Then we learned how to make paragraphs. Now we can write reports and essays and monologues and all kinds of things. But if we didn't learn those basic words in the very beginning and how to string them together and didn't understand what they meant, we'd never be able to form the sentence. And today we're going to talk about those words, those concepts, those ideas that will let you form together the sentence or the understanding to start trading and how to build your trading strategy and how to understand how a platform works, how to use it properly. All of those things which aren't very difficult to learn, but you have to learn from the beginning. So before we begin explaining why Forex trading is so popular, we will first tell you a bit more about trading in the Forex market. The truth behind this is, or why is Forex so popular? It's in fact a lie. Through the 80s and 90s, or when online, so to speak, trading started to occur, you saw all these advertisements all over. People sitting on the beach getting rich, using their, we first had laptops and everything. And, then every day you're watching people lean against Rolls Royces and their mansions and saying, oh, I made a lot of money trading online. Forex is my thing. It's a lie. Forex is work. Okay. But if you put in the effort and the work, you'll make, hopefully, money or profit or be successful. The main reason is that there are many individuals with an entrepreneurial spirit that are looking to achieve extraordinary lifestyles with their analytic skills, market knowledge, and their bravery. So, if there are millions of traders, what do these people trade? Trading is ranged from the well-known stocks of blue chip companies to exotic items such as futures or on orange juice. And what is the most popular trading? Well, people trade lots of assets, but the largest turnover is created in the Forex market. Now, when I started trading in the 70s, there was no Forex market. The only foreign currency was always handled by the bank, the central bank. And my first job as a grown-up after college was I worked for Crown Zellerbach. Many of you probably know them. I don't know if they don't, it's not that they don't exist. They've been merged, sold, renamed so many times. And they were lumber producers all over the world. And my job was balancing the currencies on deposits in every country to pay the bills in those countries and pay payrolls and to predict which ones will be higher in value. So we always had the right money and we weren't paying too much for the wrong money. But it wasn't trading. You couldn't just get online and do a bank transfer and move, 100,000 US dollars to 100,000 whatever francs were at that time. It took days to do it. And the values were constantly changing. And you had to know what the values were because there was no computers to tell you. Okay. And then after that, I went on and I became an independent trader. And I sat on the Chicago Board of Exchange and I traded agriculturals. And we sat there with our graph paper in our laps, waiting for ticker tapes to give us prices so that we could put them on our charts and watch what was happening in the markets. And we would actually hold up signs for buys and sells and whatever we were doing. Okay. But the world was a much slower place. Now, the majority of Forex transactions out there, and the Forex market is supposed to be I think it's $7 trillion a day in Forex transactions. But most of that is by multinational trade organizations, international banks, hedge funds, and private investors. Well, you, me, and a couple guys, the rest of people listening to this class, we make up only about 5% of the daily Forex volume. But 5% of $7 billion is a lot of money, a lot of trading going on. So this might sound small to you, but 5% stands for about $250 billion a day being traded by what I call retail traders. Now, it took nearly a decade for the Forex market to become an attractive place for retail traders. When we were able to start trading Forex, not we, when even the international companies were able to start trading Forex. And we had computers and the central banks could move the money a lot faster, and people started trading. It had to develop because until we had the internet and the growth of the internet, until we had things like Windows, okay, till we had PCs, till we had laptops, and then till we were able to get online trading platforms. One of the biggest, most well known is MetaTrader 4. Most of the brokers that are not using their own proprietary platform are using MetaTrader 4. But these platforms had to be developed. And I remember when I first started seeing these platforms, they were slow and retarded. They did very few things. Today, you have everything at your fingertips. Every type of order you want, every type of stop loss, everything's up to the second. Prices are being pushed out to your computer as fast as everybody else in the marketplace is getting it. News is coming out as fast. Your charts are, they're all HTML and you can adjust them. So you have all the tools to compete with the big boys or the stuff that the big boys only had because they programmed it in-house. So one of the most popular reasons for that Forex is so big is its ease of access. Unlike other markets where you have to deposit substantial amounts in order to begin your trading career, Forex trading can be started with quite a low deposit. Trading Forex starts out with as low as $100, but don't believe that. Oh, some of these brokers allow you to open an account for $100, but you can't do anything with $100. But all the tools that you need to trade are free. The charts you need, the spreads you need, the information you need is all free. So you don't have to buy things. You don't have to buy robots and AIs, and you don't have to buy, scanners, and you don't have to have everything is right there on these well advanced platforms. Now, I always say only trade with regulated brokers and only trade with the big names that are giving you all of the up to the minute tools and accessories. Today our HTML charts allow us to do everything and anything. We can customize our charts. We can set up oscillators and indicators on our charts, not by knowing how to do it, not by sitting there like I did in the old days and drawing them on and calculate, by just pushing a button. Now, yes, I know you'd like to learn more about this. And we have entire classes here on our YouTube channel that explain all of that. But I can't explain that in one short class. But we have full 1 hour classes on understanding charts. We have full 1 hour classes in just using Japanese candlestick charting. Okay? Everything is there, but you need to start with the beginning. Now, we talk about supply and demand, because supply and demand affect most of the markets in the world. But the fact is, most Forex trading is done on a short-term basis. And there is no supply limit of any of these particular assets. Now, we also talk about technological advances, and I've been talking about them so far today throughout the class. It is what makes you the best trader and the most competitive trader out there, because you have all the information and all the advanced technology you need at your fingertips. And this isn't some high-tech IT guy who can only do this because he can do it at home. No. When you sign up to trade and you start trading Forex, or today, even if you start trading cryptocurrency or doing cryptocurrency exchange or online stuff, all the platforms give you everything, because the only way these brokers stay competitive is to give you everything and have the most advanced everything for you. Most brokers today offer a minimum of three platforms. One, a downloadable platform for your PC. Okay, again, MetaTrader's 4 terminals, the best in the world. You download it, and most brokers let you use it and you just put your account numbers in. And it's got everything. It allows you to even build your own black box and robotic trading. Then most brokers today, in fact, I don't know of any, that don't offer a web trader version, which means with any internet connected device, you just use your login and password and your account's there, and you have everything. And the stuff flows from one platform to the next. It all flows with your account. And then almost every broker offers mobile access. So you can trade, check the markets, check your account, open and close a trade right on your mobile device. Now, let's talk about another reason. Most of us trade, like I'm sitting at home in my office in my house right now, big beautiful desk, big screens all over the place, but I'm sitting in my house alone. Okay? And most of us don't like just being alone. We want to be part of a community. We want to share our ideas. We want to get feedback from other people. We want to learn from other people. We don't want to learn from listening to lectures like mine. We want to learn from other traders and see what they're doing and how they're doing it. Well, today we have all types of developed communities like TradingView, one of the world's best charting services out there, which supplements the charts you have from your broker, has huge communities and forums where you're seeing what other brokers are thinking, other traders are thinking. You're seeing how they set up their charts, how they saw how they were using an indicator, an oscillator, and so that you can use it for learning, you can use it for knowledge, you can use it for to getting feedback on whatever you're doing, and you're not just sitting there alone. Now, one of the other reasons that Forex trading is very popular, and it's a concept you must understand, you must take it in, and you must understand it's got huge benefits but huge risk, and that is margin or leverage trading. Now, the margin offered to you as a trader is set by the regulators. Okay? Every trader gets margin. Okay? It's not something you apply for. It's not based on your credit scores, your job, anything else, and it's overseen by the regulator. Okay? Now, what margin does, it allows you to ramp up your trading. But for every potential profit, you have a potential loss. So remember, your potential profit always mirrors your potential loss. So you always want to use excellent risk management skills. But imagine leverage is no different than you go to the bank and say, I want to buy a house. And the bank says, okay, we have a 90-10 program. What's the 90-10 program? You put down 10%, we'll finance 90. In the case of with brokers, it's not we'll finance 90, we'll give you 90. So if you want to buy a $100,000 house, you've got to put down 10% or $10,000, and the bank will loan you or finance $90,000. Now, there is no cost or fee to leverage, except it has a small little incremental charge that's so negligible you'll never even know it, for trades that are kept open every night, and every night a tiny bit of interest is charged, but it is so small you don't even notice it. Number one. Number two, it is highly competitive, because for those of us who are trading large volumes and keeping those trades overnight, well, we would want to see what it said. The brokers don't make any money with this. So they're all competitive. So don't worry. But if you're being offered 10-to-1 leverage, means if you have $1,000 in your account, you have the purchasing power of $10,000. If you have 200 to 1 leverage and you have $1,000 in your account, you can purchase or trade $200,000 worth of trade. The reason being is Forex, and we're going to talk about pips in a minute, but Forex trades 4 digits to the right. So in other words, and Forex, let's get this straight. Forex or currency doesn't make great moves. Okay? If the euro drops 20 pips today, that's a lot, but that's 20 points to the right of the decimal point. It was an insignificant, small amount because currencies just can't move that much and that radically. Yeah, there's times when something crazy happens. There's always black swan events, crazy market events. There's always something crazy some weird central bank does. Okay. But on the whole, currencies don't move that radically, that quickly. So in other words, if you had bought, now today is a lot different than when I first started doing this class. Okay. When the euro was worth 141, 150, 160 to a dollar, well, the euro today is worth about $1 to a dollar. But say hypothetically you were trading currency ABC. ABC was trading at 98.4245. Okay. And you had $1,000 in your account and you bought $1,000 worth of that particular currency. And therefore you got 9,542, whatever the value of that currency was towards the US dollar. Okay. And you've tied up $10,000 of your money, and that currency moved 50 pips. Big move for that currency that day, up or down. Guess what you would have possibly made or profited from your $10,000 investment? Your $10,000 risk. Maybe, if it made a radical move, maybe you made $50 or $100. Well, to risk $10,000 to make $50 or $100 isn't worth it, because to buy those currency, you're buying very, very small amounts, and they're moving in small amounts. It's not like you're buying 1,000 shares of Apple at 141, and Apple goes up to 145 today and it moved $4, and your 1,000 shares made you $4,000 profit. No, a currency moved 50 pips. When I say 50, sounds like a lot, but pips, put all those decimals in front of it. So it moved 0.0050. So you need leverage. Leverage and margin are the same thing. The margin is the down payment. The leverage is what it lets you ramp up your trade to be, and there is no fee for this. But remember, it increases your risk. So what you do have to keep in mind is that Forex involves a high degree of risk, like any other trading market, or perhaps even higher. Forex trading is carried out on a margin basis, and Forex is quite a volatile market, and due to these factors, even a relatively small price fluctuation can lead to substantial profits and losses because you are leveraged. Imagine you have a $10,000 account. Well, you're now trading $2 million worth of that currency. Now, another reason that Forex is popular with us is because almost every, almost every reliable broker, respectable broker, offers demo accounts. And a demo account is used for 2 reasons. The reason demo accounts were developed and were originally offered is that as a trader, as an experienced professional trader as myself, or as you as someone starting out, but you're trading, you're building strategies, you're trying new indicators, you're trying new things, but you don't want to try that with real money. So when I want to make an adjustment to my trading strategy, I do this on a demo account because I don't know if my adjustments are going to work, or I may want to keep defining them, refining, and I don't want to do that with real money accounts, and I want to be able to do it many times over till I can test it out. Well, now that we've developed these incredibly great demo platforms, because when I first started trading, a demo platform didn't really work in the real markets. It did everything a market did, but it wasn't getting fed the live data. It wasn't getting fed phony data. Some demo accounts use all of yesterday's data, and the markets were, the charts and everything were moving just exactly like yesterday did because they're feeding in old data points. Or some of them used a circle and a cycle that kept going around because basically when you're testing something, you're not testing it. You're testing it against the numbers on that demo chart anyway, and what you're making, and it didn't matter, and we couldn't make it so easy. Okay, but now that the developers have made these demo platforms so accurate and so well, that we realized that we could give you demo platforms that use live market data. So a demo platform was then pushed out there for new traders like yourselves who haven't traded anything to try to see even if they're comfortable with this before they've made a deposit, so that while they're not using real money. And a demo platform is not for you to play a game. A demo platform isn't set up and developed because it costs the broker a lot of money to allow you to trade on a demo platform, because it's taking up server time, it's taking up data, it's taking up power. Okay, most of you don't think about it that way, but it is. And it's really developed for you to get to understand, like today's class, to get you to understand the basics. We're going to talk about all the basics today, but we're not going to get you up to trading. We've touched on charts, we've touched on the different platforms. Okay, now at some point you need to touch them and feel them and move. You've learned the words, now you need to make the sentences, but they're not there for you to play games. Okay. Too many guys come along and say, "Oh, look at that! I'm going to use the demo platform, and I see the euro trading at 101.62, and I think the euro is going to go up 101.65, or I think it's going to go up. I'm going to, invest my $5,000 I have in my demo account, and guess what it does? And all of a sudden, your demo account jumped another $10,000. Well, you know what? That's a game. It's not even gambling because you don't even have real money on the table, but you're playing a game." Okay. And what happens is you fool yourself in your head to think, "Oh, I got this down pat. Let me put some money and I'm going to make a ton of money." Well, you didn't. You just played a guessing game because the money wasn't real and the trade wasn't real. So keep that in mind. You need to make sure you put every bit of effort into understanding everything and building a trading plan, not just guessing at stuff. So now let's talk a wee bit about actual Forex trading. Now, in the Forex market, there are several fundamental terms you need to be aware of that may be different than what you understood if you traded stocks, or just from your general understanding. Now, if you've traded anything before, the fundamentals of trading currencies are basically the same. Here's one of the primary concepts you have to gather. Every Forex trade is based on not the value in your account. Say you're sitting in the US, you're not sitting in Canada, you're not sitting in Australia, you're not sitting in the UK. Your account has been opened in US dollars, and you've got $10,000 in your account. That's between you and the broker. Okay? Now, every trade you want to make in the marketplace is one currency versus the next currency, because that's how you make profit. That's how you trade. It's got nothing to do with the value in your account and the fact that your account is US dollars. So imagine if you were a stockbroker and I or you wanted to buy stock and you called your broker and you told him you want to buy 1,000 shares of Microsoft or MFB stock or Berry stock, whatever else, and he told you it was $10,000 because he told you it was in US dollars. You transfer $10,000 in your account, he buys you the stock. What did you trade? You traded US dollars for Berry stock. Now, if you were in the UK, your broker there would have told you Microsoft was trading, and Microsoft was the same price everywhere, but Microsoft was trading in pounds. And he would have told you how many pounds you had to wire him. Now, we'll get around to this. Now, keep that in mind, okay, because that was based on your currency in your account. Okay, now, what would have happened if in the UK the pound would have plummeted and the dollar would have gone up and Microsoft stayed exactly the same? So for some reason you need to get your cash back. You need the money back. A couple months went by. You need your cash back and you say, Microsoft's not doing anything. Sell my Microsoft. Now, Microsoft has not changed $1. But it happens to be the US dollar went up. But you still got for your Microsoft $10,000. Right? In the UK, the pound went down. So therefore, you need to come up with more pounds to buy that $10,000 or that 1,000 shares of Microsoft. And so when he gives you back your money, instead of giving you back the 8,000 pounds you had paid, you only get back 7,500 pounds because you lost money because the pound went down in value and you bought something that was trading in US dollars. Okay, so let's move it on a little bit farther. Let's forget about the currency that you've deposited in your account, because your account is set up in US dollars, stays in US dollars. But you think because of what's happening in Europe and what's happening in Japan, the Japanese yen is going to climb against the euro. You say, Japan just reported an incredibly great economy, and whatever's going on there is going on. They're getting good publicity, so their currency is going to go higher. Europe is still facing bigger and bigger problems. So I think the euro is going to go down. Well, forget your accounts in US dollars. You want to right now buy yen because you want to have a whole pocket full of yen because you think that yen's going to be worth a lot more money. And you think the euro is going to go down. So you want to trade the euro against the Japanese yen. Okay. You don't have any euros and you don't have any Japanese yen. But the profit you would be making would be if the Japanese yen did go up and the euro went down, you would make profit. If the euro stayed where it was and the Japanese yen went up, you would make profit. Okay. Now, if the Japanese yen would fall and the euro would stay where it was, you'd lose money. If the Japanese yen stayed where it was and the euro went up, you would make money. Okay. Now, it is only converted the profit or the loss when the trade is closed and it's traded to the current value of the US dollar and put back in your account because your account's in US dollars. So to trade Forex, you're always trading one currency against another currency. And it's the movement of those two currencies that create profit or loss, not the currency that your account is in. So to give you another example of this relationship, and it's kind of a quirky relation, but it's what you have to understand is, say You live in London. You say you live in the U.S. That's perfectly fine. I'm an American. Okay. Say you live in New York with me. Okay. Now we decide we're going on to our vacation to Australia. So I need Aussie dollars. Actually, let's forget that example. Only because I don't want to use dollars for dollars. Let's say we are back in New York and we're going to Japan on vacation. So we want to take some Japanese yen with us. Now, granted, we know we're going to take everything and charge it on our credit cards, but we want to have pocket cash. Don't want to gamble that maybe my credit card doesn't work. There's an internet problem. I want to have some money in my pocket just in case. So I go to the currency store. And in the old days, there were currency stores all over the place, just like there were American Express shops, all over selling American Express traveler's checks and all that kind of stuff. Today, most of this is done at your bank because most people don't do it much anymore anyway. But when you walk in or walk by the currency store, there's a sign that says buy and sell. They're buying US dollars for this much against yen, and they're selling US dollars against the yen for that much. There's a buy and there's a sell. So in other words, if you're buying yen, you're giving him US dollars and getting back yen. If you're selling yen, you're giving him so many yen and he's giving you back US dollars. There's always a difference. Now, when I was younger, and especially when the places were selling American Express traveler's checks and all this other stuff, there was a fee or a commission. So unless you were trading, or not trading, but unless you were exchanging a good deal of currency, that commission was very, very high. Because most of the time you didn't get past the minimum commission. So if the minimum commission was, say, $200, and you were exchanging, you're a student, you just wanted to exchange 1,000 yen, well, you know what? It became very expensive. If you were exchanging 10,000 yen, it wasn't so expensive. But over the years, these commission shops, as well as online platforms, went away from that. And they make their money just like the commission shop on the buy and the sell, the spread. The difference between what they charge you to buy and what they charge you to sell a particular currency. Now, they're small and negligible. But when you see a currency pair quoted on a platform, just like you do at the commission store, you'll see what they'll buy the yen for, what they'll sell the yen for, and also you see what the yen is technically at the spot market. And the difference between the buy and the sell is known as the spread. That spread is really the broker or the commission store or the bank's commission. But instead of charging it by a flat commission fee, it's based on what the size of your trade. And they're relatively small. The more exotic the currency, the higher the spread. But this gives you the quotes. It gives you a buy quote and a sell quote for the currency pair that you're looking at. You have to match up the currency pair that you're talking about. So it's a bid price and ask price, or a sell price and a buy price. So as you can see here in this quote, that the euro was bid at 135.09 and the ask price was at 135.11. So the difference between these two is what's known as the spread. You see also the highest price of the day, the lowest price of the day. So in this case, this price is 2 pips. And the more popular currency, the tighter the spread, the smaller it is. Now we also have contract sizes. Because we talked about you having $1,000 in your account and you wanted to buy 100,000 of the euro and you're using leverage. Okay. Now, a lot of more advanced platforms have gone away from contract size. Because all with the advanced technology, you just go in there and basically You say I want to buy the the euro against the yen, and how much it's a little ticket, and you type it in, you know, euro against the yen, how much you want to spend, and you say $10,000 or 40,000, and the computer does all the calculations. You don't have to do anything else. Okay. There are still some older platforms that make you take mini lots and micro lots and maxi lots. Well, if you're buying a lot of euro, you're buying 100,000 units. That's a standard lot size. Then we have mini lots and micro lots. But again, the more advanced platforms today, you don't have to buy a lot. You just put in how much. Just like if you're the same broker today is not only offering Forex, they're offering lots of other online trading. Same thing with stocks. You used to have to buy round lots, whole lots. Yeah. Today, you only have $10,000 in your account and you want to buy Microsoft. You want to put in $10,000. It does all the calculations for you. There's nothing you have to do anymore. But just so you do know, standard lot size is 10,000 units. Mini lot size is 10,000 units, and micro lot size is 1,000 units of that particular currency. So a micro lot size would be 1,000 yen. A mini would be 10,000 yen. A micro standard size would be 100,000 yen. But again, it really depends whether you're doing short-term trading, long-term trading, intermediate-term trading, because you can only use leverage in relatively short-term trading. It becomes different if you're looking to buy the euro against the dollar, because remember, you're not physically trading or exchanging anything. You haven't gone to the bank with $100,000 in cash, hand them $100,000 in cash, and they hand you back 102,000 euros. You don't have anything. So most of these trades are done in short term. Okay. And I keep mentioning it, and we'll go over it again, but the easiest way to define a pip is whatever the number is, 4 digits to the left, to the right of the decimal point. But a pip actually stands for a word. It stands for percentage in point. A pip was typically defined as the smallest price change that a currency can move. However, recent price developments have extended the granularity another decimal place further. And what's happened is, because our platforms have gotten so advanced and our computers have gotten so advanced, it's like when you buy stock, you see stock trading at $141.25, 30 cents, 40 cents. But if we started trading stocks at $141.52 and a half cents, okay, well, what's happened is we started moving over farther and farther to the right. When I was younger, we would only talk about the euro being, say, at 117.5. Well, now we talk about the euro being at 117.50, and the euro can move to 117.51. That's $1 and 1 7, so 17 cents, 17 and a half cents, and I don't even know how to say 17 and a half and 10 cents, a tenth of a cent. That's a fractional little number, but it's the smallest amount that currency could move. The biggest difference one that you have to keep in mind is the Japanese yen. And I won't go into history and how the Japanese yen got to be this way, but the Japanese yen is traded in big numbers. And it's not traded in points to the right. So just remember, it's the smallest increment you can trade it in. But say hypothetically, we were talking about leverage and profits and everything else before. A euro, a standard pip, is 4 digits to the right, or 1 point. A standard lot size, if you bought a whole lot, that's 100,000 units of the euro. So if it moved 1 pip, okay, it would be 0.0001 times 100,000 units, or 100,000 euros, and your profit per pip movement was $10. So if it had moved 50 pips, guess what? 50 times $10 is $500. Now we have pip calculators. I never use them. I I'm not trying to figure out exactly what I'm making is because my computer will tell me. I just want to know if I'm trading the euro to the dollar and I'm buying at 117.5. I know I made profit when I close at 117.51 and it gets put into my account. And now traders can make profits on buying and selling long or short positions. You can technically go long or go short. Going long, say if you thought the yen was going to go up and the euro was going to come down, you would what? Buy the yen, sell the euro. Correct? This is what your first opening trade would be. Now, as I mentioned before, if the yen went up and the euro stayed where it was, you'd make profit. If the euro went down like you thought it was and the yen went up like you thought it was, you made more profit. If the euro went up and the yen stayed where it was, you would have lost money. If the euro stayed where it was and the Japanese yen and fallen, you would have lost money. But that's because we opened a euro Japanese yen. We sold euro, we bought yen. Now, if you thought the reverse was going to happen, you could go short and do the exact opposite. Sell the Japanese yen and buy the euro. Now, we discussed margin and the fact that there's no cost to margin. When you're putting down your 10%, it's a down payment just like in your house. The bank said, "We'll finance the house. You buying $100,000 house, we'll finance 90. You give us 10. When you sell the house back for $100,000, you pay the bank their 90. You get your 10 back. But be aware that margin and leverage ramp up your trading and profits, but do the same in reverse. They increase your risk and they have potential loss. Now, there is a lot more to learn. There are many different types of orders. There's market orders and limit orders. Okay. And you need to know these. A market order tells the computer to make your trade at the current market value now based on everything you set up. A limit order, you set the price in which you're willing to buy or sell the pair for. And if it hits that point, the computer will execute your order. Okay. There are other things like OCOs. One closes the other. If you're not sure which way it's going to go, you can tell the computer, if you start to see the Japanese yen climbing, then buy the yen. But if you see it falling, sell the yen. Because you think some event's going to happen during the day that's going to do that. And the computer will do one or the other, and it technically has two trades sitting there waiting to open. And it just says, whichever one the computer opens first, close the other trade. Don't make the other trade. Okay. But limit orders are the best way to go. So you can do all your calculations, set up everything, tell the computer at what price you're willing to buy. And then we have stop orders. Now today we call these stop losses. In the old days they were a little bit more complex because you had to place an order opposite of what your buy was to tell the computer to close out your trade if the market started moving against you because you wanted to limit your losses. So in other words, if the Japanese yen stayed where it was, wasn't moving at all, and the euro started climbing up, you'd want to close your trade as soon as that started to happen, basically. So you could have set up a reverse order that would have had the computer executed. Today we call these stop loss orders. And you just tell the computer what you're willing to risk for a loss or at what price do you want to close out your trade, and the computer will automatically close out your trade if the market starts moving against you or you start showing a loss. And there's several different types of stop loss orders. The one I always use is called a trailing stop loss. A trailing stop loss moves the price of the close order continually in the direction that the trade is moving. Okay. And so if the Japanese yen is going up and I'm very happy and I'm making money, I don't want to close out my trade, but I want to say at any point if the Japanese yen falls 5 pips from where it's been, close my trade because it'll also help me lock out in profit. But these are some of the basics. But when you open a demo account, you can try them all out and learn them. And we have OCO, GTC, good, it's good to cancel. GFD, good for the day. There's a lot of times you're not sure what's going to happen. You know, you think there might be an event that's going to cause something. You can set up an order to, because remember, you're not, unless you're doing a market order, the computer's not executing that order until it follows the instructions you gave it. So if you thought the dollar was going to go up today because something was going to happen with the central bank, but you're not sure, you can tell the computer, if the dollar goes up to this level or higher, execute my order. But if it doesn't do it by the end of the day, forget that I ever placed the order. But you also can do GTC, which means good to cancel. You can tell anytime, for instance, anytime the US dollar gets above this level or gets to this level, execute an order for me. And it will stay on that computer and will execute it any time that occurrence happens until you tell the computer not to forget about it. So there's many different ways and many different things you have to learn. Now there's also trading styles. Now I've mentioned day trader, short-term trader today. So we've all heard to each their own. And there's many different ways that you want to trade. Day trader used to be a thing. Used to be the guy sitting on the beach telling you he's day trading. I converted everything to short-term traders. Most of us today are either long-term investors, position investors, and they're investors. They're buying something, paying for it, holding on to it, whether it's for 3 or 6 months or holding on to retirement. And then there's short-term traders. We are not looking to say Microsoft's going to go up over the next 2 years. We're looking to say that right now today's price of Microsoft is lower than it should be, and we think something's going to push Microsoft up today. Right now there's this online battle between Twitter and Apple, okay, and there's an online battle or online problem with Apple and iPhones in China. So we may think that this news and these headlines today might send Apple down lower. Okay? We don't care what the real value of Apple is. We only care that we think Apple's too high at the moment, and sometime today, or maybe tomorrow, by tomorrow, it's going to dip down a little bit. We're going to take our profit between where it is today and where it dips to, not what it's really valued at. So day trading or short-term trading is for active traders that have time throughout the day to stay on top of the current news and to change their minds on a dime if they see other opportunities elsewhere. Swing traders are people who want to keep trades open for a week to a month. And swing traders tend to be a mixed bag of traders who have strong technical focus and very good understanding of general fundamentals of a marketplace. And then position traders. Position traders are much longer term traders who hold positions for weeks and even months. So position traders generally focus on fundamental shifts in the world economies, looking at the health of specific economies or their interest rate policies, and when making a trading decision. And as I've mentioned, trading risks. Trading currencies on margin involves a high level of risk, and as such, may not be suitable to those investors who are adverse to risk. And you always want to make sure you protect yourself and manage your risk. But keep in mind, Forex trading is not a get-rich-quick scheme. You're not going to get online today. You're not going to decide to open an account today. You're not going to master it all day, and you're not going to be making profits today. It's a slow learning process. And as you master that process, you'll become the man in command. Okay? You don't want a surgeon operating you just because he read a book and watched a video. So, let me ask you a question. If a professional football player has played ball since he was 13 and learned all that stuff each year as he grew, but now he's getting paid millions of dollars. But that guy who's getting paid millions of dollars practices every day, learns every bit of everybody's plays, learns defense, is out doing scrimmages, out doing everything, preparing himself to get paid those $1 million. It's a lot of work. You think a guy who's getting signed a contract for $50 million, have it all down pat, just go out and do his thing. They work hard all day, every day. And so does a trader. And they learn to master the tools and techniques used by professional traders. You understand the language. Okay? You understand what is going on in the market. You learn technical analysis. Okay? Now, technical analysis isn't scary. Don't let it scare you away. I call it chart analysis. But it's how to read price on a chart and understand what price is trying to tell you. Whether it's just looking at a chart, whether it is using oscillators and indicators, but it is what will, it only works great for short-term traders, but it will let you know whether that price should have the momentum to carry it upward or downward. And fundamental analysis, you should always be aware what politics might do, what a central bank might be ready to do, what emerge. I mean, I'll go back a couple years ago. Now we know we have all the war going on with Russia, insanity. But years before this, we had a short-term blitz where Russia invaded Ukraine. It happened on a weekend. Now I knew oil prices would go crazy Monday morning. And oil jumped from like $46 a barrel to, I think it broke 102. Well, I had set up my orders on my online platform overnight to be executed first thing Monday morning as soon as the market opened. I think I got in at 68. I sold at 98. Okay, a ton of money was to be made, and this was on a fundamental event. But you have to be aware of what assets, what currencies, what can happen when certain events take place. Look, these protests in Japan and China, I said, we know they'll be quelled. We don't know if the Chinese will come out with military and just shoot all the, but we know. But for the short term, it's having a big effect on their markets, on their real estate prices, as well as the Chinese yuan. So if you were trading dollar against yuan, it might have offered an opportunity. It may be too late to get in the market. When it gets to be world news and headlines of all the papers, it's usually too late. But remember, practice makes perfect. Every trader makes mistakes. So it's a good idea to familiarize yourself with a trading environment before you invest your money. To improve your trading, try opening a free demo trading account with a major Forex company. So, this is the end of our class, and it's the beginning of your journey. This was a real basic class, but it's the class where you start. And now if you look on my YouTube channel, you'll see, I think there's 1,600 videos. They're divided technical analysis, strategy, start somewhere. Start slowly. Go watch my video on charting. Then watch the video on advanced charting. See these on your demo platform, and because each platform's slightly different, each platform's modified by the broker, understand them. Get to figure out what it's all like. But Japanese candlesticks are candlesticks no matter what broker you're looking at. Charting and 5-minute charts, 15-minute charts, 30-minute charts. Price action reading, price action trading pattern. But don't just blindly go in there and start wasting your money. So thank you very much for joining us today, and hopefully you're starting an incredibly great journey. Bye now.